If one day you help a billionaire, and he wants to repay you, he gives you two choices. Option 1, he gives you 1 million every day for 30 days. Option 2, he gives you $1 on the first day, $2 on the second day, and doubles the amount each day for 30 days. Which one would you choose? Take 5 seconds to think and share your answer in the comments. After 30 days, if you chose the first option, you would have a total of 30 million. If you chose the second option, you would have a staggering 1,073.74 million. Einstein once said, "The most powerful and formidable force in the world is not an atomic bomb but the combination of compound interest plus time." Value investors, especially the iconic Warren Buffett, leverage the power of compounding to generate high returns over extended periods. Starting with $300,000 in 1957, Buffett's assets surpassed $100 billion by 2021, with an average annual return of approximately 20%. This achievement ranks him as the sixth wealthiest individual globally, joining the exclusive club of billionaires. While maintaining a 20% return is a remarkable feat, the key lies not just in the rate of return but in time. Many attribute Buffett's wealth to his longevity. He is currently 90 years old. Thus, the true power of compounding is revealed through the passage of time. So, what exactly is compounding? Let me share a well-known story with you. In ancient India, there was a minister named Sissa who invented chess. The king, delighted by the game, asked Sissa if he had any requests. Sissa replied, "Your Majesty, I ask for nothing but to place 1 grain of wheat on the first square of this chessboard, 2 on the second, 4 on the third, and so on, doubling the amount for each square until all 64 squares are filled. I request you to reward your servant with this." The king, thinking it a modest request, agreed. However, when the grains of wheat were brought in bags and the calculations began, the king realized he had been outsmarted. Even if all the wheat in India or the entire world were used, it wouldn't fulfill the minister's request. Though rich and powerful, the king couldn't meet this demand. According to calculations, filling the entire chessboard this way would require about 82 billion tons of wheat. At the current global wheat production rate, it would take approximately 550 years to meet the clever inventor's request. This enormous number illustrates how compounding operates, often imperceptible in the short term. Most of us behave like the king, not realizing the potential of doubling a single grain of wheat. The powerful effects are hidden in the distant future. Things that don't show an immediate difference are easily overlooked by most. This is why there is only one Buffett in the world. No one is willing to become rich slowly. If you harness the unseen forces of nature, you gain a tremendous advantage. As the stock market guru Buffett says, life is like a snowball, all you need is wet snow and a long slope. The ball gets bigger as it rolls down. There are 3 factors that affect compounding. First, the long slope time. The longer the slope, the more time it has to accumulate. Second, wet snow rate of return. The rate at which the snowball rolls depends on the wetness of the snow. Third, starting size of the snowball initial investment, the size at the beginning, which is our initial capital. Starting with every $10,000 at a consistent 10% rate of return, after 30 years, it becomes $174,000. However, if you start with only $5,000, after 30 years, it's only $87,000. The difference is substantial, $90,000. Therefore, avoid unnecessary spending because every $10,000 saved for investment can turn into a significant amount in the future. When Buffett started his career, despite having the means to buy a house, he chose to rent. He said, "Money, like tools for a craftsman, loses its power when invested in a house." Small differences in return rates, over a sufficiently long period, result in significant disparities. For instance, a 15% return over 20 years multiplies the capital by 16 times. A 20% return over the same period multiplies it by 38 times. The difference between the two is only 1-fold, but after 50 years, With a 15% return rate, it becomes 1083 times, and with a 20% return rate, it becomes 9,100 times. The two differ by a factor of 8. It can be said that increasing the return rate is the main goal investors strive for every day. The number of years for compounding is also crucial. With a 20% return rate, it becomes 6 times in 10 years, 30 times in 20 years, and 9,100 times in 50 years. The returns in the last 5 years are twice that of the previous 45 years. This effect is very surprising. Buffett once stated that 99% of his wealth was accumulated after the age of 50. In the snowballing process, avoid interference or friction, as compounding is highly sensitive to large losses. Regardless of how high you've climbed in the first 50 years, a 90% loss in the 51st year can undo everything. Investing wisely is crucial for effective compounding. How can one achieve compounding with low risk? Let's start by sharing another famous story, the story of the seemingly endless Nobel Prize Fund. The Nobel Foundation was established in 1896 with a donation of $9.8 million from Alfred Nobel. According to Nobel's will, the foundation could only invest in safe assets, adopting a rather conservative investment strategy, such as bank deposits or bonds, and was prohibited from buying stocks. However, as everyone knows, while fixed deposits are low risk, the returns are also low. After over 50 years, with the annual prize payouts and operational expenses, the foundation's assets had dwindled by 2/3. By 1953, the foundation's assets were just over $3 million, which, due to inflation, was equivalent to $300,000 in 1896. The intended prize amounts seemed increasingly meager. Facing bankruptcy, the foundation's committee decided to lift the restriction on not investing in stocks. Seeking help from McKinsey, they transformed the remaining $3 million bank deposit into capital and hired professionals to invest in stocks and real estate. This new financial approach completely turned the fate of the Nobel Foundation. Instead of decreasing, the fund not only stabilized but, by 2005, had grown to $540 million. From 1901 to the present, a span of 111 years, the total prize money awarded by the Nobel Foundation has far surpassed Nobel's original endowment. From 1953 to the present, the Nobel Foundation has achieved an annual return rate of over 20%. This is the asset allocation structure of the Nobel Foundation. In conclusion, high returns don't always have to come from high-risk endeavors. Long-term investment and the compounding effect are relatively stable and favorable approaches. While the returns from long-term investments might not seem remarkable in the short term, the probability of success is higher. Rather than getting tangled up in indecision about investment strategies, it's better to exercise patience and let time bloom the flower of wealth. Additionally, in investments, attention should be given to the safety of the principal amount, and the effects brought by time should be valued. Upholding long-term investment, as time accumulates, the compounding effect triggers exponential growth that becomes increasingly apparent. The investment strategy of the Nobel Foundation is simple yet effective. For novice investors, here are 3 principles to consider. First, diversification of risks. Just as you wouldn't put all your eggs in one basket, investments should be diversified to mitigate risks associated with a particular industry or sector downturn. Second, asset allocation. Enjoy growth from different sectors and possess various types of assets. This strategy can significantly reduce volatility without compromising returns. Third, long-term investment. When you make profits from investments, reinvest these gains. The longer the investment horizon, the greater the compounding effect, leading to the doubling and redoubling of the principal amount. Don't forget to like, share, comment, and subscribe.